Hey everyone, in today's video, I'm going to go over the 3 different ways that a company can fund an acquisition. This is a common topic that is tested in finance interviews. First, I'm going to give an overview of the 3 different funding sources, and then I'm going to talk through different benefits and considerations for each funding source. All right, let's jump into it. The 3 different ways a company can fund an acquisition include using cash, using debt, and using equity. First, using cash. A company can use the cash that it has accumulated on its balance sheet to fund an acquisition. Second, using debt. A company can borrow money from a financial institution to fund an acquisition. And finally, using equity. A company can issue additional equity to fund an acquisition. Now let's take a look at the advantages and disadvantages for each funding source, starting with cash. The benefits to using cash include that it is cheap. Using cash from the company's balance sheet is the cheapest way to fund an acquisition, given that the company has already accumulated this amount and will only be giving up the interest income that it currently earns, which in this environment is close to zero. Second, certainty of funds. The buyer does not have to rely on a third party for funding, given that it already owns this cash. And third, the buyer does not have to give up any control of the combined entity and will not have to give up any ownership to the seller. Now for considerations. If the buyer uses all cash to pay the seller will have to pay taxes day one on the amount of cash received. Second, opportunity cost. While using cash to fund an acquisition does not have any direct monetary cost, the company should weigh its options and see if this cash balance could be better invested in other internal initiatives, such as buying new machinery, or if they should keep this cash on their balance sheet to make sure they have enough liquidity going forward. Now let's take a look at debt. The main benefits to using debt to fund an acquisition is that the interest payments due on the amount of borrowed money will be tax deductible, serving as a tax shield for the company. And just like for cash, the company will be able to maintain full ownership of the combined entity and will not have to give up any control to the seller. Now for considerations, the company will have an additional financial obligation and will be required to pay back the third party for the amount of borrowed funds. Also, the company will have additional interest expense, and while this is good in the sense that it will serve as a tax shield, ultimately this will lower the amount of cash flow that the company takes home each year. And finally, just like for cash, the seller will be required to pay taxes day one on the amount received. Finally, equity. The main benefits of using equity to fund an acquisition is that the seller can share in the potential upside of the combined entity now that they will own a portion of the company. And second, the seller will be able to defer any taxes until they sell their equity portion and will not have to pay cash taxes day one. Now, the main consideration to using equity is that the buyer's ownership stake will get diluted by the portion given to the seller, meaning that the buyer will have to give up some control to the seller. Now to sum everything up, the 3 main ways to fund an acquisition include using cash, using debt, and using equity, and there are advantages and disadvantages to each source of funding. Hopefully you now have a better understanding of the 3 ways a company can fund an acquisition. And if this topic is ever brought up in an interview, you can rattle off the advantages and disadvantages to each funding source. Now, if you found this video helpful, please like and subscribe below, and I look forward to talking to you guys again soon.